Over the past year, each of these challenges has grown more acute. The foundations of Europe's growth, expanding world trade and high-value exports, have weakened further. The US has imposed its highest tariffs since the smooth-Hawley era. China has become an even stronger competitor, both in third markets and as US tariffs divert flows inside Europe itself. Since December last year, China's trade surplus with the European Union has risen by almost 20%. We've also seen how Europe's ability to respond is limited by its dependencies, even when our economic weight is and remains considerable. Reliance on the US for defense was quoted as one of the reasons we had to accept a trade deal largely on American terms. Dependence on Chinese critical materials has curtailed our ability to prevent China's overcapacity from flooding Europe or to counter its support for Russia. The ECB now puts annual investment requirements for 25-31 at nearly 1.2 trillion, up from 800 billion a year ago. The public share has almost doubled from 24% to 43%, an extra $500 billion a year, as defense is mainly publicly funded. Fiscal space is scarce, and without this new spending, EU public debt is set to rise 10 percentage points over the next decade, reaching 93% of GDP on growth assumptions that are more optimistic than what it is at the present day. 1 year on, Europe is therefore in a harder place. Our growth model is fading, vulnerabilities are mounting, and there is no clear path to finance the investments we need. And we've been reminded painfully that inaction threatens not only our competitiveness, but also our sovereignty. But they also express growing frustration. They are disappointed by how slowly the EU moves. They see us failing to match the speed of change elsewhere. They are ready to act, but fear governments have not grasped the gravity of the moment. Too often, excuses are made for our slowness. We say it's simply how the EU is built, that a complex process with many actors must be respected. Sometimes, inertia is even presented as respect for the rule of law. I think that's complacency. Competitors in US and China are far less constrained, even when acting within the law. To carry on as usual is to resign ourselves to falling behind. A different path demands new speed, scale, and intensity. The EIB finds European firms are taking up advanced technologies at the pace close to US peers, though from a lower base. But the gaps are stark. On the AI frontier, the US produced 40 large foundation models last year, China 15, the EU just 3. Among SMEs, AI adoption is still low, ranging from 13 to 21%, and in the most strategic field, AI built on European intellectual property to anchor our core industry, progress is minimal. There are 3 areas where more ambition is needed. First, as the President has remarked before, removing barriers to scaling up new technologies. A true 28th regime must become reality, allowing innovative firms to operate, trade, and raise financing seamlessly across all 27 member states, just as competitors can in other large economies. This is especially important to give young Europeans a chance in their continent. They want to stay here. They don't want to go elsewhere to have success. Natural gas prices in the EU are still nearly 4 times higher than in the United States. Industrial power prices are on average more than double. Unless this gap narrows, the transition to high-tech economy will stall. Energy is as fundamental as technology in driving AI. Electricity demand by data centers in Europe will rise by 70% in 2030. Power already accounts for up to 40% of their operating costs. The IEA warns that without action, 1 in 5 planned projects globally could be delayed by grid bottlenecks. Only countries that align energy strategy with digital policy will capture the largest gains in the AI race. The Commission has launched its Clean Industrial Deal and the Action Plan for Affordable Energy, both consistent with the report's agenda. But the main step so far has been to relax state aid rules so member states can subsidize prices. That may offer temporary relief, but it doesn't fix the structural reasons why energy in Europe is so expensive. This includes gas prices that, following Russia's invasion of Ukraine, are still about double their pre-COVID levels. Europe is already the world's largest buyer of US LNG and has committed to purchase up to $750 billion in US energy products. Whatever the conditions of that deal, it should be treated as a chance to reorganize how we purchase gas. Since March, LNG landed in Europe has cost from 60 to 90% more than the same gas would cost in the United States, even after accounting for logistics and regasification. Collective EU purchasing, as first proposed by the Commission after Russia's invasion, could certainly narrow this gap by strengthening our bargaining power, reducing intermediaries' margins, and shielding us from volatile spot markets. In parallel, Europe must deliver on the work of Gas Market Task Force and bring more transparency to energy trading. Profits for the 4 largest global traders quadrupled between 20 and 22. Used strategically, IPCIs could help Europe achieve scale in sectors like innovative nuclear technologies, such as small modular reactors, or in the automotive supply chain for affordable zero and low-emission vehicles. The Commission is taking measures to make such projects more attractive and accessible. But the EPCI model is still essentially national in design and funding, and this creates an inherent ceiling compared to our competitors. Take Europe's semiconductor IPCI approved in 2023. It mobilized 80 billion euros of public funding spread across 14 member states, 68 projects, and 56 companies. The overarching target, reaching a 20% global share of semiconductor manufacturing by 2030, is one the European Court of Auditors already calls very unlikely. As a comparison, take Japan's Rapidus shows a different approach. Created in 2022, it channels $12 billion of public support, despite Japan's smaller economy, into a single large-scale leader in advanced chips. It is focused on clear objectives, backed by major firms as investors and anchor customers. And it moves far faster, aiming for mass production by 2027. Ultimately, in some crucial areas, Europe must act less like a confederation and more like a federation. But such reform will take time we may not have. In the meantime, progress may depend on coalitions of the willing, using mechanisms such as enhanced cooperation. Even without treaty change, Europe could already go much further by concentrating projects and pooling resources. If we succeed in focusing our efforts in this way, the logical next step is to consider common debt for common projects, whether at EU level or among a coalition of member states, to amplify the benefits of coordination. Joint issuance would not magically expand fiscal space, but it would allow Europe to finance larger projects in areas that lift productivity, breakthrough innovation, scale technologies, defense R&D, or energy grids, where fragmented national spending can no longer deliver. By raising output faster than interest costs, such projects will gradually restore fiscal space and make broader investment needs easier to finance. And I will conclude on the same lines as Ursula a moment ago. Europe's citizens are asking that their leaders raise their eyes from their daily concerns towards their common European destiny and grasp the scale of the challenge. Only unity of intent and urgency of response will show that they are ready to meet extraordinary times with extraordinary action. Thank you.